Hi, and welcome to the urbantech VC, a podcast for urban leaders shaping the cities of tomorrow. If you love our show, do drop us a review, share it with your friends, and follow 2BX on LinkedIn or Instagram. Today, we're happy to welcome Jürgen, CEO of Primonial REIM, a key player in the European real estate asset management sector. They are fully aware of the impact of real estate on the planet and society. Primonial integrates environmental, social, and governance issues in the company's operations and in the investment solutions that they manage. If you're an urban tech founder about to raise a round, do reach out to us. We'd love to connect and see if we should play together. Are you tired of always hearing about Silicon Valley VCs and not knowing what the greats of European VC are thinking? Well, no more. Head on over to eu.vc, the go-to place for everything European VC. You'll find podcasts, events, and expert-curated content from all over the EU VC scene. Well, what are you waiting for? Go to eu.vc.
Hi, Jürgen. Happy to welcome you to the urbantech VC. Lovely to have you with us. It would be great, as we know each other now for quite a while, but probably parts of our audience doesn't. If you could briefly introduce yourself and tell us a little bit more about who is Jürgen Fenk and what is he actually doing right now?
Hello, everybody. My name is Jürgen Fenk. I'm doing what I've done in the last 30 years. I'm doing real estate right now for a company called Primonial REIM, Real Estate Investment Management, based in Paris. I'm the CEO of this company and building with all my colleagues a European platform, which basically means we are an asset manager and a wealth manager for retail and institutional clients in the European real estate market. So we invest on behalf of these clients in mostly all asset classes across Europe.
Now, the important question here is, how did you end up being the CEO there? Like, what drives you in what you're doing?
I was never driven by title. I was always driven by the challenge. I have a long banking career behind me for most of, 25 years, roughly. And at some point, I decided to, before it's too late, to go to the other side of the real estate market. Some people say the dark side. And I joined a private real estate company for about 3 years. It's always opportunities that I've never been looking for that made where I am now and where I went before. So opportunistic approach to career, but always driven by being able to create something, to establish not necessarily something new, but something bigger, something more interesting, something more international, or more this or more that. In this case, Primonial, it was interesting for me to go back to a more international business, to a more European approach, to work with different cultures, different people. We have a lot of young people, more than 50% women in our company. And to build something with these people was actually the reason why I accepted this offer and this challenge. And so far, so good. Works well.
Cool, super inspiring. Mark wants to say something, but I'm just so intrigued. Because now the new title for you in my head is opinion seeker or challenge seeker. That is I really like that.
Yeah, that is a quite cool one. But I had to laugh a little bit when you said, okay, I changed from banking to the transactional, to the real estate side or to the dark side. I would assume, depends on who you ask, what is the dark side of the industry, whether it is banking or the real estate side or the transactional business.
I think the one says it about the other.
Yeah.
and the truth is there is no dark side. I mean, there are some black sheeps in the industry like in any other industry, but it's just interesting to be on various sides of this in this industry. I've been, financing. I've been developing. I am now an asset manager, and it's always related to capital, so debt and equity. But the core is always the real estate. And I was always intrigued by real estate since I'm very young. So I have chosen this industry not by coincidence. It was really something that I wanted to be in.
Maybe two follow-on questions with regards to Primonial. One, and you said it before, you're an asset manager right now with a quite interesting mix when it comes to investors, as far as I understood. So you have a more or less 50-50 quota retail and institutionals. That is correct, right?
That is correct.
So can you tell us a little bit how this shapes actually what you're doing and what's the impact on the business model that you're having?
Right now, in the markets in which we are, it is actually very good not to be dependent on only one source of capital. So having our retail clients, and especially our French retail clients, is very positive to have, because the institutional market is right now more or less standstill at the moment, because people scratch their heads and wonder, in which direction the market is going. What is the right pricing and what the right valuation in the market? What is my allocation as an investor towards real estate compared to other asset classes? So it's good to have this balance between retail and institutional. Now, what we have been trying is to have another balance between French institutional and non-French institutional, mainly being international institutional investors. So we have been investing in people with ability to attract, obviously combined with our products, international institutional investors. So it's a different investor type, but at the end, the money you invest in real estate is coming from different sources, but you invest in similar projects. It's somehow can be different from a yield perspective. Our institutional investors are more looking for, some of them at least, for IRR is a key hurdle. Retail investors are more looking at cash on cash. So what is actually the dividend they receive on a monthly or on the yearly basis? This is the difference. But at the end of the day, you invest in real estate, that's the same.
Yeah, that is quite interesting. And I think this perspective will come back at a couple of points in our podcast. And to have it in mind and to keep it in mind is something that is, I think, very good for the rest of this show. So maybe one last follow-on question before we jump right into the first topic. With Primonial, you focus on not even a handful on particular asset classes. All of them or most of them are related to urban areas or the center of urban areas. Can you explain a little bit what is the connection to urban areas from a Primonial perspective and why focusing on particularly this asset classes and real estate that you're focusing on?
I mean, I tend to say that real estate by definition is urban areas. Now, we do invest in a lot of senior housing, which you can say not everything is in urban areas. At least it's not in large cities necessarily, because it's where the demographic is, it's where the people live. So it's nursing homes, also clinics, hospitals that you can find also in regions. So that is not maybe the urban area like a big city like Paris, Berlin, or London. Anything else, which is, can be office, can be hospitality, hotels, which is other living asset classes like co-living, normal build to rent, so rental. It's mainly and mostly in cities. And especially, unlike Germany, France is a very concentrated country, so most of our assets are in Paris. But for me, real estate is always related to urban area. Urban area is real estate, so it's connected.
I mean, urban areas don't have that much more right now than the buildings, the real estate there to offer. But yeah, we would like to jump directly to the first topic, the impact of inflation. So a tricky one. Looking at that, 2.5 years now into COVID recovery, the world economy is facing the prospects of a new downturn. So we have the rising inflation being accelerated even by the war's impact on energy prices, and we have reducing real incomes while pushing up interest rates. So now we're at a point where inflation becomes a serious threat to general wealth in Europe and in the US as well. And you have been through different crises throughout your career. I'm not saying here you are old, because you mentioned you're super young, and we would say you're experienced. But in your point of view, we're super curious about what separates the current market environment from the crisis in 2007 or 2001.
What do we use to say age is just a number? No, I can tell you, ages also has a lot of advantages in situations like the one we are. It's experience. Yes, I have experienced more than two crises in my career. But if you refer to the financial crisis in 2008 and the one in 2000, which was the so-called dot-com bust, I lived in this crisis. I worked during this crisis, and it is actually not bad having experienced crisis, because people who have not just see, only the positive trends in anything. Where if you have been in crisis, you probably look at downside scenarios more closer. So the main difference between today and those crises is actually easy. The former crisis, basically, especially the financial crisis 2007-8, was credit driven, and you had debt-related excesses built up in housing and in internet infrastructure at the time, and it took nearly a decade for the economy to absorb them. And by contrast, this crisis in which we are is an excess liquidity crisis, not a debt crisis. So it's based on, COVID-related fiscal and monetary stimuluses pumped money into households and in investment markets, and this now has led to high inflation and is driving speculation in financial assets. That is a completely different scenario than what we had in 2008. And I think one difference and consequence at the same time is that the damage to corporate earnings tend to be more modest during inflation-driven recessions. We had other recessions that were inflation-driven before, not in all countries, not globally, but in the US, for example, in 82. And I was even looking beyond 73, which, I was already born, but I didn't work at the time, where you had huge differences in terms of profit decreases, so profit fell compared to today. So the situation of the corporates was stronger, or is stronger, in an inflation-driven situation than in a debt-driven recession. And on top, you have other factors, but I don't want to go too much into details, that are different, and that I would say are positive signs. We have a labor market that is super dynamic. We have a housing industry that is still strong. We have good balance sheets of corporates, as I said before, and corporate revenues are also strong. So it's a kind of a weird situation in which we are. It's difficult to say what the outcome is. In general, we can talk about real estate, but it's something that, in the combination of what you said, energy crisis, the Ukraine war, a kind of a mix of issues that we have never seen before.
I think one very important point that you touched upon also from our point of view is the differentiation in what causes the crisis, especially when you compare the real estate market now to 2007, 2008. What is very interesting to me, and what I would like to dig a little bit deeper into, when you look at the inflation in particular sectors, at the moment, of course, electricity and gas and energy drives also inflation in housing prices, or not in the prices, asset prices itself, but in the costs for housing, right? So from a consumer perspective. So that is why everybody thinks, or is one of the reasons why everybody thinks housing prices will decline. What happened also in the 2007, 2008 crisis, right? But on the other hand, we still have a huge demand when we look at, for example, the asset class of residential, right? So the demand is not going to go away, especially in urban areas. We need more housing. We're underserved all over Europe at the moment. So what would be your expectations, specifically looking at residential portfolios? Because there is this kind of like demand and supply crisis that is still going on that will drive asset prices, or should drive asset prices.
Yeah, it's an interesting and very actual topic, because we just had this afternoon, before this podcast, a pre-investment committee on the large residential deal. And on one hand, you're right, there is demand in the market. Now you have to differentiate between residential to buy and residential to rent. Residential to buy will probably suffer because interest rates have come up. So for people, it's much more expensive to afford debt to buy a home, where the rental market, in my view, stays strong because of the lack of product. I mean, you both are in Berlin. I'm now in Paris. That's, mainly no difference to the fact that it's very hard to find an apartment to rent. Rents have come up, continue to go up, so that market stays strong. But if you look at the capital market has basically shifted overnight. I mean, over certain periods. We used to say overnight because it happened so quick, by 3% in terms of interest rates. So from a negative interest rate environment, moving now to more or less 3% swap rate. That's a huge difference. And what happens not only for residential, but also for every other asset class, there may be a repricing because just the cost of debt has come up, and debt is used as a leverage for real estate investments. So you just don't calculate anymore the same way. Will we see yield movements in real estate? Definitely we will. Will we see it in residential, and especially in rental residential? Probably less. It's right now we are in this process of a repricing of the market. So there are very little transactions going on in the market. Why? Because the seller and the buyer are not meeting each other at the price level. The seller still has his old price from 6 months ago, and the buyer is looking at the new conditions and say, why should I buy real estate at, 3%, if I can buy bonds at 3% or 3.5%? The risk premium that I need for my real estate investment need to be there, meaning that on the top of my risk-free investment, which is a government bond, I need to have whatever percentage these investors are looking for. And therefore, it means the prices have to come down. And this is happening, but slowly, very slowly, because at the same time, we all don't know yet to what extent ECB will further increase interest rates. And there will be probably an interest rate announcement this week. The market is assuming 75 basis points, and there may be another one in December. And since we don't know, the market is just in a kind of a wait-to-see position where very few deals actually happen. And the deals that happen are deals that are either already, on the distress side, but there are not many yet, or on assets that are super solid assets where you can say, okay, there's little repricing potential, or we believe that the yields are not really shifting a lot. And one of that is probably rental residential. Long answer to your question.
But I think a really amazing answer, which I want to, because you took us totally already into our second topic, but you said something very interesting. No, that is perfectly fine. I mean, but you mentioned the ECB, right, and the interest rate announcements. And over time, the ECB always kind of like oriented their interest politics with regards to what the Fed were doing in the US. So there always has been a connection somewhat. Now what we have seen is over the past month a very aggressive increase in interest rates by the Fed, but still inflation in the US seems to not be affected so far positively, right? So the latest inflation numbers in the US have been quite bad. At the same time, the ECB might have not that much room due to debt structure in Europe when it comes to the States, risking another Greek debt crisis or similar things in different European states. So what would be your take? What is actually the freedom of movement or decision-making that the ECB has at the moment? How far can they go? What would be your take there?
Yeah, I'm not an economist, but you already said most of the answer. ECB is more balanced and has to be more balanced because they're managing different countries. The Fed is managing one country. The Fed is super aggressively fighting inflation. Even if inflation is not yet really moving down, they will continue to do so, even if at the risk of a recession. And we all know that in the US, things are much more volatile. So the recession may come earlier, may last shorter, where in Europe everything takes longer and then lasts longer. So this is something that also when you have gray hairs, that you know that. So I think ECB has been underestimating the inflation in Europe. and it's between, actually governments and corporate debt versus purchase power of people. And this has to be balanced. If they won't fight inflation, we will have, I would say, difficult situations in most countries with the purchase power of people. And inflation will then eat into salaries. And then you have the so-called second and third round effects of inflation, because everybody has to turn inflation to the next one. So you take a baker, the baker cannot live with 10% inflation without putting this on his clients. Otherwise, he's not surviving. So bread will more expensive, and any product will more expensive. But if the population is not getting any more salaries, how can they afford things? So this is one side. On the other side, you have this government debt problem. If you increase rates, the cost of debt of any country and any corporate will go up, and corporates will suffer and countries will suffer. Just take Italy, how much the country risk of Italy has gone up, and basically the bond price of the country Italy, not only because of the change of government or the election before, but people see the indebtedness of the country and say, now if they have to pay 5% interest or 1% interest, it's a big difference. So this is the balance that the ECB has to do. My view is, I don't know if I have a view. I think it has been now more or less clearly said by members of the board of ECB that they will do another interest rate increase. And this may happen this week. And then other voices say there may be another one also at the level of 75 basis points before the end of this year. Would there be then more? I doubt, because then we would reach a level of interest rates that would really hurt the debt side of everybody. It would have an impact on growth. It will certainly be a risk for a recession combined with everything else that's going on. It will be tough to even then continue to increase the rates. Now, would these rates bring inflation down? I don't know. I'm not an economist, and I think we have situations in this particular moment that are not normal and that we haven't seen. Because energy dependency on Russia, alternative energies, where Germany does get the energy from, and anybody who would provide energy to Germany will do it at a price. This is how markets work. So I'm not sure that we will bring inflation down quickly. And the interesting thing, just because I'm in the European business, if you look at the difference between Germany and France in terms of inflation, there is a 4% difference. Inflation in France is roughly 6%, Germany is now roughly 10%. It varies, but it's huge. It's a huge difference for two countries, neighbors. And the main reason is just coming from the energy side.
This is so interesting because that is exactly the point. And when you take Italy also in the equation, Italy has Germany at the moment has latest numbers from the ECB, 10.9% inflation rate. France has 6.2%. Difference mainly driven through energy prices. When you look at Italy, Italy has 9.9%, but 72% or nearly 33% inflation when it comes to energy. So then if you look at buying power, of the average Italian, and you look at the different classes that you have, then inflation is not that high. The interesting thing is, or the question is, and maybe that is something that we can also think about, and that also in terms of how do we deal with real estate at the moment, isn't that a good time to invest into new sources of energy, also from not only from a political standpoint, but also from an investment standpoint, because opportunity costs are going down. So it might be a better thing to invest into cleaner energy, into more decentralized energy, to get a certain independence on those, at the moment, very singular inflation drivers.
Absolutely. I don't want to talk about my personal investments, but clearly looking at shares of companies being in alternative energy sectors is something that I would do. Well, we are a real estate company, a real estate investor, so energy is an important factor for our decision making. Not that we buy energy, but we look at low energy consuming buildings. For us, the existing energy cost and the future energy cost is certainly one of the criteria of our decision making, which is part of the entire ESG approach of our business. But yes, we have been too dependent for years in Germany, get used to this low cost of energy, and this fires back now more than any other country.
You touched upon the topic ESG, and we would love to briefly discuss that with you as well, the role, future of ESG in real estate. So Primonial, you mentioned it, is focused on different asset class. Let's now focus on healthcare, offices, whatever. And you see that there will be different play in these asset classes with regard to ESG and decarbonization. And you have a belief that the S in ESG will become more relevant in the real estate sector. We would definitely agree. But we are super curious to know, like, two things. Why do you think so? Why will the S in ESG will become more relevant? And where does the real estate industry stand right now when it comes to the S in ESG, in your opinion?
I mean, for a long time, most people, when we started to talk about ESG, it was mainly the E that people were talking about. It took a long time before actions have been taken. Now we have some actions. We are talking about decarbonization of real estate. We are looking at the Krebs path. Every company has now its ESG responsible. We are working in different strategies. The S was never really a topic. I think the S has become much more a topic over the last 18 months. It's very difficult yet to exactly define what S in ESG means. I mean, it's social, but what does it mean? Social impact in real estate. By being probably the largest investor in Europe in healthcare assets, nursing homes, clinics, etc., we have the S in our investment business because it is an S if you invest in this asset class. It's a commitment to providing infrastructure for the society. Now, you can define the S by an asset class, but the S is much more. It's the social impact you give through real estate to the communities, contributing to urban space, urban area, and not only having buildings in the city, but actually a life in the city and making cities more attractive is the role of the real estate industry. Not only, but also. The other role is mainly also the government and the politician. But I already said it about 15 years ago that the real estate industry need to be more responsible for the social component of what we do. I challenged a lot of people by asking if they would give 0.5% of their return, for example, institutions, foundations, to do something good into a city. Many years ago, I looked like if I would come from the moon. Now, and since some time, not only me, but also other people say the same and try to do the same. So it's a lot of things that need to come together, but it's just not just buying or building a building. You have to provide more these days. You have to provide an energy efficient building. You have to reduce your carbon emission. You have to propose social infrastructure, giving something to the people, not only who work in the building, but also who use the building or walk by the building or whatever they do with the building, depending on the asset class that it is. And for us, ESG is super important. I mean, anybody you have in your podcast will probably say that, but for us, it's super important at three levels: corporate level, what we do as a company for that; the fund level, the funds we have, we want to have them all according to Article 8, Article 9, and at the asset level, where we work a lot on data, on getting ESG components into the assets. Basically, it has a cost, but we need to do it.
Yeah, for sure. What would you say is the biggest challenge to really establish that or to implement that?
First of all, you need data. You need to know what your consumption is. You need data. You need tech solutions. And very often, and you know this very well and much better, the real estate industry is looking more and more to startups, helping them to solve the issues that they cannot solve on their own because they're looking at things differently, more traditionally, and you have people that have bright ideas for solutions. You need money. So if you are in an asset management business, the funds do not necessarily have the liquidity, but you have to generate that. So it very often goes potentially touches the return. And that goes back to, for example, social impact investment. Would we be ready to have a lower return if we generate social impact? The same is on the E as well. Would we be ready to have a lower return if we have better buildings? For a long time until now, the answer was no. People still want to have the same return, but they want on top the E, the S, and maybe also the G. The positive thing, it's now in people's mind, it's in everybody's head that ESG is not just an option, it's a must. But now we are in a market situation where I see the potential risk that ESG strategies are slightly scaled back because of need of liquidity for something else. So that's a potential risk I see currently.
Mm-hmm.
What you just said, very interesting point. You said, okay, maybe ESG initiatives have to scale back because of liquidity pressure, right? So if I understood you correctly, that is a risk or that is a fear.
It's a fear. It's a fear. I'm not saying it has to. I just believe it can be that it will happen.
Yeah. In connection to that, you said something very interesting in connection to the social responsibility, particularly of real estate companies. And you have experience from a role in the supervisory board of a big residential real estate company in Germany that has a huge portfolio in Berlin. And there has been an initiative a year ago. The voters in Berlin voted for this initiative to take housings or housing units of this particular company into the hand of the municipality or the local government. So that is a direct impact of obviously social pressure to a certain degree and not enough offering. Not saying that I'm in favor of those initiatives, but don't you think that pressure from society from many, many sides will increase and will also force companies to focus particularly more on the social acceptance of their product, e.g. their assets?
Yeah, absolutely. I can't comment on this particular company since I'm sitting on the supervisory board, so I hope you understand. But in general, absolutely. I mean, you take any developer today in German cities, it became much more difficult for them to get the approval to build what they initially wanted to build because there's a pushback from the city and the population not to have just another office building somewhere, but what is a building bringing to me as a citizen? And I think it's just the beginning. I personally believe that anybody who works in real estate has just to, as I said before, it's not just a question of return. It's just also what you bring to the society with what you do and what building you build or you renovate or whatever. That pressure will potentially increase. The main pressure comes from social housing. I mean, from the affordability of housing, that's for sure. But, the same as another shopping center, huge shopping center somewhere. Who needs it? Why do we need it? Why can't we have just more smaller, more interesting shops somewhere in the city? All those things you and I, as a citizen of a city, we think and we would like to have. And that's a role of the industry to respond to that.
It's super interesting. I have to think about another session we had, another episode with an architect where he described the shift, like in how architects used to develop buildings, like very egocentric buildings, to express something. And now that it's more about finding something that fits into the reality, the surrounding, like the lives of people living there and being there. That reminded me.
And an architect has a big role as well to all this. And that's the reason why we have more mixed-use buildings, obviously, because it's mixed-use building had different lives than just an office building where people go in the morning and out in the evening. And that makes good buildings make cities more interesting and on the long term more appealing for people to live there. It's a big discussion, that we have since many, many years at ULI, Urban Land Institute. It's exactly that. How you bring public and private real estate together, how you make cities more livable.
I mean, the title of this podcast is or we want to discuss with you a little bit about the opportunity in the current market environment, on the current crisis, right? And we touched upon the topic of the economic potential of, for example, decentralized energy production investments at the moment, but also from a real estate perspective. Couldn't be an investment in ESG relevant topics in your portfolio be a mitigation for the expected asset price decline? So could that be one of the opportunities that you say, okay, if you invest now in future relevant topics, this will be a very good mitigation strategy given the fact that you have the liquidity to do so?
I mean, it would imply that the market is already pricing in or making the difference between good and bad buildings. And it starts to happen. Investors are looking more and more for ESG criteria in their investments. It's funny you say that because we are working on a product which we call a decarbonization office strategy. So the idea is to buy existing office buildings and to put a decarbonization strategy on it, which means basically you invest capex to reduce energy costs directly. So it's a direct approach, capex versus reduction of energy cost and obviously carbon emission. We believe it's the right strategy to do. Now it needs certainly pricing adjustments in the market to buy these buildings at an attractive price to be able to put these investments on top and still to generate a return. But it's an example of things that we are currently looking at.
You know that also a lot of founders are listening to this podcast, and we're working with very interesting founders. A couple of them, or a lot of them, are selling to big corporate clients in the real estate environment or delivering solutions in that space. What would you tell them? What is the biggest opportunity? Where could they anchor? What is the biggest lever to imply at the moment? Or should they just leave their potential customers alone and wait for everything to settle?
No, definitely not. I mean, we said it in our board meeting last week that this is now the time where asset management is key. You had periods and years back where you made money just because of financial engineering. And the asset management, which is really working on the assets and providing good assets to your tenants or your consumers, is now the challenge, and it's key. And even though, we may see corporates reducing budgets for this and that, I think they want reduced budgets to make their buildings appealing to their tenants. And that can be different things. That can be ESG-driven things, so environment. It can be user experience for tenants. It can be all sorts of things. I mean, we have a list of 25 topics that we need to cover with the help of interesting and smart people and startups to achieve in our buildings. And we need to do it because otherwise the building will become obsolete or it will just not stay interesting. And if you lose your tenant because you don't work on your asset, I mean, then you have not understood what asset management actually means. But I can't give one or two or three examples. It depends on your building, whether you have an office building, whether you have a shopping center, whether you have residential. But it's definitely not the case, in my view, that people cut back budgets for a better usage of the building.
Unfortunately, Jürgen, we have to come to an end. We love, Mark and I, to end our episodes with a quick fire round. Now we ask you like 10 questions and you have to use your gut feeling to answer very quickly without really thinking about it. So are you ready for that?
I am ready for that.
Perfect.
So Jürgen, startup or corporate?
Corporate.
Urban or rural area?
Professionally urban, privately rural.
Environmental or social impact?
Both. Does that count?
Oof.
Both.
Both. I understand. Oof. Was waiting for the answer here.
No,
of course, it doesn't count. But hey, you have that joker. You used it now.
Okay,
now it's not allowed anymore. Build new or modernize?
Modernize.
High-rise or low-rise building?
High-rise.
Bike or public transport?
Public transport.
Rent or own a car?
None of those. No car.
Okay.
No car at all.
Public transport.
Very good.
Disruptive or keeping with tradition?
Disruptive.
Work from home or from the office?
Both. Sorry, I have to take the joke again, but that's the truth. It's half-half.
Order online or go shopping?
Go shopping.
I have one last question. So given the fact that I know that you also are into surfing, longboard or shortboard?
Longboard.
Like it or not.
Okay.
10 minutes surfing in my age or 1 hour? It's 10 minutes.
I mean, it depends on how long the pedaling is, right? So not the surfing.
That's true.
Thank you so much for joining, Jürgen. It was a real pleasure. It's always like super nice to be in touch with you and to learn a lot of you. So you're definitely a role model for me and I think for Mark as well. If we build up something great with 2BX, we want to be a bit like Jürgen is.
Thank you for the compliment. Same for me. I enjoy talking to you. I would like to do this more often, even outside of a podcast. Good luck for you. Good luck for your founders. Good luck for your business. And hope to see you and hear you soon.
Yeah,
perfect.
We will. There will be no way around it. So looking forward to talking to you again soon. And thank you so much for taking the time. And we are right on time. So this is it for today. Thank you very much for listening to our podcast, everyone. And have a nice day.
Thank you for listening to this week's episode of the urbantech VC, a podcast for urban leaders shaping the cities of tomorrow. If you love our show, do drop us a review, share it with your friends, and follow 2BX on LinkedIn or Instagram. And if you are about to raise a round, drop us a note at LinkedIn or via email at idea@2bx.vc. Let's have a talk and see where we can help. Are you tired of always hearing about Silicon Valley VCs and not knowing what the greats of European VC are thinking? Well, no more. Head on over to eu.vc, the go-to place for everything European VC. You'll find podcasts, events, and expert-curated content from all over the EU VC scene. Well, what are you waiting for? Go to eu.vc.